welcome. You joined us on Commodity Central right here on ET Now. I'm Ashesha Adwaryu, and on the show today, we are going to put the spotlight on India's steel industry. Remember, steel prices have been rising for the last several months. So is the trend reversing, or will the up move continue? That's the big question now. Coking coal prices too have been volatile because of West Asia crisis. So where is India's steel industry headed? To discuss this in greater detail, we are now joined by Mr. Manish Gupta, Senior Director and Deputy Chief Ratings Officer at Crisil Ratings, who is now joining us. Mr. Gupta, thank you so much for taking your time out. And I was just going through your report, and you've spoken about several factors which continue to remain at play for India's steel industry. We'll talk about them one by one, but first let's start by talking about steel prices. They've been rising, and that was reflected in the quarterly earnings that steel companies reported for the first quarter of FY27. But do you expect the momentum of steel price up move to continue for the next few months?
Yeah, first of all, thank you, Shasha, for having me on the show. Yeah, you're right. I think steel prices have been on the rise. And this is predominantly because domestic steel industry is going through a very interesting phase. While global steel demand is on a decline for last 4 years, India's domestic steel demand has been growing pretty strong. And that is something which is actually helping the steel prices, the domestic steel prices to continue. One of the reason also is to do with the fact that, the raw material prices, they have also been on the rise. And in order to pass on these raw material prices to the customer, the prices have to keep pace. And that's something which is resulting in higher steel prices in India.
Okay, so that's as far as steel prices are concerned. And Mr. Gupta, you did talk about demand and the fact that demand in Indian market continues to remain very resilient. If you can put some numbers into perspective for our viewers, how much volume growth should we expect over the next few quarters?
Yeah, so last year the demand grew by around somewhere close to 6 to 8%. And this year we are expecting some bit of a moderation, but will still be pretty strong at 5 to 7% growth to be coming up. This growth is going to be predominantly driven by construction and infrastructure sectors. And among the construction sector, the demand is supported by affordable housing, commercial real estate, and increasing adoption of prefabricated steel structures as well. While government-led infrastructure spending is something which is underpinning the demand coming from the infrastructure sector as well. In addition, we are also seeing sectors such as transport, engineering, manufacturing linked sectors. They are also actually supporting domestic demand growth as well. So all in all, I think demand seems to be pretty strong for the domestic markets.
Okay, so demand continues to remain very strong in the domestic market. That's the word coming in. But Mr. Gupta, let's also talk about cost of production. We've seen across the board surge in raw material prices, and largely because of West Asia over the last few months. Where do you think coking coal and iron ore prices are headed in the near term? And what kind of impact could that have on spreads going forward? How is EBITDA per ton expected to move given how volatile raw material prices have been?
Yeah, that's right. Like coking coal, this accounts for around 40% of the production cost for primary steel makers. This is expected to be 5 to 7% more expensive. And this is predominantly coming from the supply disruptions, which is, of course, as you rightly said, the West Asia crisis. So that is something which is leading to it. In addition, some of the key exporting regions are also seeing some supply disruption over there. So net, I mean, from a coking coal perspective, we're definitely seeing that the prices to remain pretty high. The iron ore prices are also likely to be on a higher side. But the other second part of your question, which is more to do with the per ton EBITDAs, the spreads. So the spreads are likely to remain steady. And there are two reasons. As I said earlier also, the steel demand continues to be pretty robust in the domestic market. And second element is to do with the safeguard duties, which have been put in place since last year. And these safeguard duties are also protecting some of the surplus trade that is available on the steel markets globally to be coming into India, and helping the players to pass on the cost price surges to the customers as well. So net per ton EBITDAs are expected to remain somewhere close to around 10,500 to 11,000 per ton. And this is somewhat similar to what we have seen as a decadal average as well. It remains pretty steady and strong.
Okay, so spreads are expected to remain steady and strong at par with the decadal average that we've seen. But let's also talk about capital expenditure and what is the sense that you're getting with mill owners and with steel companies on ground with respect to how much capital expenditure they are likely to incur in this fiscal versus last fiscal?
See, last fiscal, the industry did CapEx of somewhere close to around 70,000 odd crores. This year, again, we are expecting 75 to 80,000 crore of CapEx to be happening. Good part of this CapEx is directed towards capacity expansion projects. And these are like long gestation projects, as you're aware. So somewhere close to 3 to 4 years of brownfield expansion is nowhere gone. So that's the kind of investment cycle we are at this point in time. However, this kind of a capex, if I look at it from a capex intensity perspective, which is to say, from an analyst standpoint, when we see capex intensity, we say it in terms of capex to EBITDA. So this capex intensity is still moderate vis-a-vis what the decadal average we have seen. To give you some numbers over there, the capex to EBITDA is likely to remain somewhere close to around 1.35 to 1.4 times this fiscal. This will be lower than the decadal average of around 1.75 times that we have seen since 2017. So that is where we are on the capacity expansion at this stage.
Okay, so that's the view with respect to capacity expansion plans of most of these steel companies. But Mr. Gupta, thank you so much for taking your time out and joining us here on ET Now and giving us a perspective on where the steel market is headed going forward. Thank you for joining us today.
Thank you, Shesha.
And with that, it's a wrap on this edition of the show. Thanks so much for tuning in. More news and updates will continue on the other side. Stay tuned.